Welcome to this market and economic update. In this video, we look back at the main themes from the first 6 months of 2026 and explore what helped drive solid market performance during that time. There's an old saying that smooth seas do not make skillful sailors. The first half of this year certainly put that to the test. Investors faced a war in Iran, rising oil prices pushing up inflation, and ongoing questions about artificial intelligence. Despite all of that, markets reached new record highs. Company profits grew by double digits, and many types of investments delivered strong results. In the next few minutes, we will walk through some of the big themes that could keep shaping markets in the second half of 2026. Let us begin by looking at where we stand in the economic cycle. The current period of economic growth started back in April 2020, near the lowest point of the pandemic. That means this growth phase is now in its 7th year, which may come as a surprise to many people given how often a recession seemed just around the corner. As this chart shows, some economic expansions have lasted 10 years or more, including the recovery that followed the 2008 financial crisis and the long growth period of the 1990s. The fact that the economy is still expanding shows just how resilient it has been. Right now, the overall picture looks fairly encouraging. Inflation is running high, but may be close to its peak. The job market has bounced back after slowing down last year. Business spending has picked up, and consumers are still opening their wallets, even if they feel a bit cautious. Historically, conditions like these have tended to be supportive for financial markets over the long term. This chart shows how a broad range of investment types contributed to positive returns so far this year. The second quarter was especially strong across the board. Part of the reason is the markets began to recover at the start of April after the initial shock caused by the conflict in Iran. Company profits have also been a big driver. Earnings for companies in the S&P 500, which is an index that tracks the 500 largest U.S. companies, rose more than 20% over the past 12 months. Another notable development is the number of major initial public offerings, or IPOs. An IPO is when a private company sells shares to the public for the first time. SpaceX completed one this year, and listings from OpenAI and Anthropic are expected. These events tend to generate a lot of buzz, but what really matters for investors is how these businesses perform over many years. That is where lasting value tends to be built. It is also worth pointing out that U.S. stock prices are on the higher side. The S&P 500 is currently trading at around 20 times annual earnings, which is above the long-term average of 16 times. This does not tell us what markets will do in the short term, but it is a good reminder to keep a balanced mix of investments. Let us turn to inflation. The conflict in Iran disrupted the flow of oil through the Strait of Hormuz and pushed the price of Brent crude oil to nearly $120 a barrel earlier this year. As a result, headline inflation, which is measured by something called the Consumer Price Index, or CPI, rose to 4.2% in May. The CPI tracks the prices of everyday goods and services. However, core inflation, which removes the more volatile food and energy prices from the calculation, stayed at 2.9%. This suggests that price pressures in the broader economy have been more contained. The encouraging news is that oil prices have since dropped back to around $70 per barrel, and many economists are cautiously hopeful that inflation may be near its peak. This pattern has played out before. After Russia invaded Ukraine in 2022, oil prices and inflation also spiked, and then came back down once conditions stabilized. Now let us talk about market volatility, which simply means how much prices move up and down. How investors choose to respond to volatility often matters more than the volatility itself. The VIX is a widely used measure of expected market volatility, and it is currently sitting below its long-term average. As this chart shows, periods of sharp price swings have also created opportunities for investors with a long-term focus. The biggest decline in the S&P 500 so far in 2026 was about 9%. That kind of drop is never easy to sit through, but markets have not only recovered from it, they have gone to set 24 new all-time highs this year. The investors who tend to benefit the most are those who stay the course during the difficult moments rather than selling out of fear. Finally, one result of the market uncertainty in recent years is that a record amount of money is sitting in cash on the sidelines. Assets held in money market funds, which are low risk accounts that hold short term investments, have now reached 7.9 trillion. That is more than double what they were before the pandemic. Cash can feel like a safe place, but it comes with a hidden cost. With headline inflation running about 4%, the actual buying power of cash is slowly shrinking over time. Even when short term interest rates look attractive, they often fail to keep up with inflation in the long run. This is why holding a well balanced portfolio that can benefit from growth, income, and protection of capital remains so important, particularly as the economic cycle continues to mature. We hope you found these insights helpful. If you would like to learn more about any of these topics, please do not hesitate to reach out. We look forward to speaking with you.